Thank you. I request Pramodar Hegde to give welcome address.
Good afternoon, members. I take it a very proud privilege to give a welcome address for this August gathering. Firstly, apologies for starting late. So I have cut down my welcome speech fully. I'll just welcome you in a single line. Because when we have the startup committee chairman and our central council member and regional vice chairman, so I don't think I should be taking too much time. So let's hear from the horse mouth rather. We all know that Bangalore is a startup hub. And there was a joke which was being cracked. Don't discuss your ideas. Probably the cab driver might listen to your idea and he might start a startup. So that is the city which we are in. And it's a very great privilege. And of course, I thank Dheeraj Khandelwal to at least.
He is chairman of Committee on MSME, Committee for Development of International Trade, chairman of Committee on Public and Government Financial Management, vice chairman of Committee for Development of International Trade 2021-22, and vice chairman of Valuation Standards Board, vice chairman of Committee for Members of Entrepreneurship and Public Service 2022-23. I request Kavita Parmesh, our treasurer, to introduce speaker for the first session, Siddharth Pai.
Chief Finance Officer and ESG Officer at 314 Capital. It's an early stage venture capital fund. Siddharth leads his team at the 314 Capital, which is a team of professionals and business analysts that manage and oversees the fund's end-to-end processes, from deal evaluations to the diligence, structuring, and investment, all the legal activities also. The team has developed deep domain expertise in Indian market across these functions and has created several playbooks that have become benchmarks for the industry. Siddharth also contributes actively to the growth of AIF industry in India. He has been the youngest executive council member of the Indian Venture Capital Association and twice running co-chair of the Regulatory Affairs Committee. He has worked with government departments and regulators on matters related to the industry and has served as a member on several government committees, which has positively impacted the industry and the startups. He is an expert council member of iSpirit, an Indian software and product advocacy think tank, and also the founding member and vice president of PEVC CFO, the collective CFO of venture capital and private equity funds. Siddharth is a qualified chartered accountant from the Institute of Chartered Accountants of India and holds a bachelor degree from St. Joseph's Commerce College, Bengaluru. It's my pleasure to introduce him to all of you. Welcome to you, Siddharth. Thank you.
Thank you, Kavita. Now, I request all the dignitaries on the dais to join us for lighting the lamp.
Teshu Jagrati Yaesha Sukteshu Jagrati Kamam 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 Kamimanaha Tadeva Shukram Tadeva Shukram Brahma Asmin lokaha Sarve tadunatyavi kaschan Etadvaita 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 Etadvaita
ಸಭೆಗೆ ನಮಸ್ಕಾರ. Good afternoon, members. Welcome to all of you for this ICAI Startup Manthan. Dignitaries on the dais, we have the chairman of this particular committee at ICAI, Dheeraj Khandelwal, CA Dheeraj Khandelwal. Then we have the vice chairman of SARC, Geeta Adyam, the vice chairman of Bangalore branch, Pramod, Secretary Manjunath, the first speaker of this particular 2 days Manthan, CA Siddharth Pai. When in this fraternity in Bangalore, when we hear a word called Pai, usually we will relate it to Mohandas Pai. So he is son of Mohandas Pai. Mohandas Pai is a grown-up and he is a startup. So today he has come here to take us through or explain to us something about the startup. Let me give the overview of this 2 days program. After this inauguration, a brief inauguration, he will be taking us through, Siddharth Pai is the first speaker. He will be taking us through the navigating the world of startup investment, angel, VC and seed funding. Then followed, we have another session, cultivating the entrepreneurial mindset and idea generation, CA Ankit Fachpuria. After the tea break, we have 2 more sessions today. Building a strong foundation, legal and operational aspects, CA Guru Prasad M. Then for the last session of the day, we have navigating the tax landscape, financial planning for startups, CA KL Prashant. This is followed by dinner. Then tomorrow, we start this particular program again at 2:30. We have one session, transforming ideas into robust business plans, which will be dealt by Mr. Bhushan Arun Patil, followed by tokenization revolution, unveiling the future of infrastructure and pioneering opportunities for Indian startups in the next decade. Mr. Sharat Chandra will be addressing us. He's a co-founder, India Blockchain Forum. Post tea break, we have another 2 sessions, protecting your digital fortress, cybersecurity essentials for new businesses. CA E. Narasimhan will speak. Then last session will be unblocking the worth, strategies for evaluating startup valuation, CA Dina Jacob. So this will be the 2 days overview of what we are having this ICAI Startup Manthan. I hope each and every one of you will participate fully in this 2 days conference and make the best use of this. Of course, apart from the CPE 12 hours credit. So today morning I sent a message to all of you. Maybe you would have, if you are in my WhatsApp group, from this year onwards, CPA has to be completed within the calendar year. There is no question of carry forward of extra credits. So 40 hours credit has to be completed within this year itself, and the due date is 31st of December. Of course, we are all used to many due dates. This is one due date for ourselves to complete the CPA credit by 31st of December. I hope all of you would have completed. If you have not completed, the branch will do a lot of programs in this month. Kindly participate and complete that. One is the aspect of CPE. The second one is to know more about this MSME and the startup. Because Bangalore is considered as the startup hub of this country. And as professionals, we have a lot of things to contribute to this particular area. To tell about Dheeraj Khandelwal, last year he was the chairman of that MSME committee. With consultation with the government, we had one Yatra, MSME Yatra, where we had one bus which traveled across all the regions of India, that is entire India, for 75 days, conducting 75 programs, meeting all the MSME officers across India, and that gave lot of insights or lot of, I should say, education to the MSME sector in this country. He may have the statistics, I may not have that much of statistics. The number of registrations before Yatra and afterwards, it's a huge numbers which got registered. So this is something which we did on behalf of the government. Even government was very, very happy with these initiatives. Then this year, as a chairman of this startup committee, he organized one program at Mumbai. It was also a startup manthan, which was very well attended and received by the entire community as such. And we are also requesting him and working with him to have a very big program on startups in the coming months. So he said this is a curtain raiser. So still picture bhi baki hai. So this is part 1, part 2. Now you know all these movies. It will come in 2 parts. First part, second part, and sometimes even they will show the third part also will be coming. So this is, he said, will be the first part. We will come with the second part in coming months as such. What we have to do as professionals? I think we all know about CSR, corporate social responsibility, but now I'm talking about CPR. CPR means one is consultation. So in this MSME and startups, whenever a new client comes to us, it's our responsibility to give them various consultation to them. It's not just taxation consultation like what are the exemptions you will get under income tax, what are the exemptions you will get under GST. Beyond that, there may be a lot of things. Like for MSME, if you take, there are a lot of, I should say, benefits given by each and every state as such. Apart from what the central government gives, even Karnataka government may give, Andhra may give. Every state will have certain things that has to be offered to these MSME and startups. So as chartered accountants, I wish that all of us can understand those things, what are all the benefits that is available for a MSME or startup, that consultation we can give. The second thing is P when I said, that is professional guidance. See, most of the, we say that Bangalore is a startup hub. I don't know the statistics, how many startups have started and how many startups have stopped there itself after 1 or 2 years. So that is also there. It's not that every startups which start, it will take off. So there may be various reasons. One of the reason may be the financial discipline. Lack of financial discipline with those startups may be one of the reason what I feel. And here the professionals play an important role. As chartered accountants, we should ensure that the financial discipline is maintained in that particular company as such. Otherwise, there may be chances that more than success, failures may be there. So this professional guidance, when I'm saying, we should, as chartered accountants, guide them properly. Let us not guide them whatever is there under the law. Like a startup comes, you tell him that you do ESOPs, you issue shares and all. Until unless they get to a particular level, we should not guide them all those things. We may be knowing all the formalities or what all the rules and regulations. We should see what has to be given to them at what time, so that they will not lose their track as such. So other than these things, maybe financial discipline, when I said, even maybe you can help them in preparation of accounts or maintenance of books of accounts and even other whatever things they have to do with MSME and startup. The last one is R, that is reporting, which is a core area of each and every chartered accountant here, the auditing and assurance functions. So reporting also, you can see what best you can give the reporting and how you can guide them. Apart from this, there are certain opportunities for chartered accountants also. One is in MSME, now MSMEs also can be listed. So recently one of our associate listed one of the MSME company as such in the stock market. So when once MSME company is listed, there are opportunities for professionals to become independent directors. So those things are also there. So I hope you learn whatever much more is there. What I said is only very, very little. We have various speakers in the next 2 days. I wish that all of you would have completed all your official work. There's no professional work, there's no due date in today and tomorrow. So all of you can sit here relaxedly, learn whatever is been given from these expert speakers, enjoy these 2 days conference.
Dignitaries on the dais, the very dynamic Central Council member who always focus on for the growth of the members in terms of the professions. Not only in the conference, even in the council table. He always highly speak for the benefit of the MSMEs or SMPs. None other than my good friend, Srinivas Kotha, the speaker of the day. I can say the finest speaker and role model. He created his own brand name. And one of the recent, I had the incidents, when I invited him the June, 27th June, the Tata Sphere in Mumbai, where the crowd was, more than 7,000 people. And immediately I asked him, to have the interview for the G Business. And the G Business aired his show, talk, on the startup, on the venture fund, and it's gone viral. It's created a huge impact to the public. And I'm told by the G Business, because in the startup, people are looking forward funding, how to raise the fund. That's the important crux. And that's why he's sitting and he's none other than, so I welcome him, the Siddharth Pai, to this particular forum. And again, able vice chairman of this particular region, Geeta, And one of my good friend, I can say good friend from this your branch, Pramod and Manjunath, and my all friends over here from the particular this branch managing committee people and friends over here. I think this is a great opportunity to be here to interact with you, the cutter reason for this startup sphere. And that's the things, this area from, non-conventional area where we chartered accountant used to focus, now has to focus it. They has to look forward to the various opportunities, and this is another opportunity in MSME and the startup. Today I'm going to focus on the startups. As rightly mentioned by the Srinivas, we had a MSME Yatra last year. Before that, I'm heading this committee in the last 3 years. The very first year, we focused ourselves to have more and more awareness program towards the chartered accountant, about the subsidies, about the state government, central government, and various planning and strategy, CFO, SEXO, and kind of services. And we conducted around 120 webinars on this particular MSME program, and created the website msme.icai.org. We give in to the members, you have to give a solution to the clients. If members are looking forward, I have to plan a food subsidy unit, a food processing unit, whether in the Bangalore, whether in the Karnataka or Andhra or UP or Bihar. How you will judge it? You have to go through the all laws, then you compare it. But ICAI already came out with the comparative chart in msme.ici.org. Just you have to click the food processing industries, looking the which sector or area, you will come to know the comparative chart. What are the subsidies are rateable, what are the policies are available of the central government or state government as well. You will surprised to know that you will come to know that 90% capital grants are available, by 50% by the central government and 40% by the state government. That's the things which we created. And last year, we wanted to have India to be grow a $5 trillion economy. We need to have the chartered accountant to involve, and where the chartered accountant can develop the economy of our industries, which is a 100%, maybe about 10 crore MSME sectors are there. Out of the 10 crore MSME sectors, 94% are belong to the micro, and 4% belong to the small, and the 2%, 1 or 2% medium enterprises. And we can give the guidance to the all micro from the 94% to the zero level, and where the our role going to be there. And that is why for that, every industry has to register for a registration, Uddham registration. And you will surprised to know that when we started this MSME Yatra, there were only 1 crore MSME registration. And within the 3 months' time, we ended with the 2 crore registration. The registration when we started 1 crore, that's from the, it took 15 years. And for completing a 1 crore more registration, just completed 3 months' time. How we did? We travel across the India 22,000 kilometers. All cities, we connected with all MLAs, MPs, local people, and constructed bus. We came out with the SBI, SIDBI, Exim Bank, all other that's MSME, central government, state government together, and took the camp, resorted, and made the planning it. And that's why we also had a clinic where about the 10-20 people were there just to get the registration of the MSME in the Uddham registration. And that's why the Prime Minister Modi has appreciated lots in Man Ki Baat, that's ICAI has did a lot good work for the MSME things. And that's why we got the India Award as well as the Asia Book of Records Award for this having a awareness drive and completing 1 crore startup registration, that's Uddham registration. And this year, the startup sphere, where the Siddharth and Ankit Fatehpuria, all other people, Zina Jacob, all the speakers are there, were witness to have this startup sphere. Now my point is again is that we chartered accountant should not confine to the conventional practice. We should always look beyond the startup and other opportunities. in startup, I can say they are the three tier of the opportunity. What the startup means? Startup means is the startup which having the new idea with the technology and having the scalability. Definitely can be a startup. And we chartered accountant can be a entrepreneur. We are entrepreneur. This is not a new streamline. This streamline used to be earlier also. In 90s, Siddharth, I can say that in 90s, we chartered accountant already tested the flavor of the startup. In 90s, Bombay Stock Exchange given the membership card to the 90 people, most all chartered accountant, all chartered accountant. Whether the Anand Rathi or Nirmal Jain or Motilal Oswal, everyone got in 92, 91 to 92, all the membership card. And they become now the largest employer in the chartered accountancy. They are the entrepreneurs. Now people call wealth management. People used to say that in broker. Now it's a wealth management company, investment banking company. So we are not something new. We are having the entrepreneurship. The practice is also entrepreneurship. We are taking a risk. We are taking in the clients, all different clients. We are talking to them, but we forget the uniqueness, scalability. These things are missing. Then definitely we can be a part of the startup with the technology. We can be a part of the fintechs. One of the solutions which bringing to the clients with the technology scalability, and definitely it's becoming fintech. Nothing new in the practice. Everything, whole package system can be there, and new startup can come out in the fintech. And that's why we chartered accountant can be a entrepreneur as a founder. And second thing, the chartered accountant, we can also be a co-founder, because most of the startups are being headed by the IIT IIMs. They need financial people. They need financial people as a co-founder. We can be a co-founder for that startup to looking the funding aspects. The third, we can be a investor. We most of seniors people over here. The US have the 7 lakh angel investors. And India still we are figuring out, for 30 to 40,000 angel investors. And I can say that with having the 4 lakh community of the chartered accountant, we can play important role to be angel network, angel investors. And we can give the funding. We are investing money in the secondary market, in the share market, buying the stocks. Why? Because we know the analysis of the balance sheets. We are analyzing the balance sheet of the listed entity. We can analyze the balance sheet of the startup also. We can check the the investors and take a call, and there we can have a good returns. And most of the venture funds right now headed by the chartered accountant. And that's why one of the example is Siddharth Pai is heading this one startup fund. So you can say that most of the startup venture fund headed by the chartered accountant. This is another opportunity to be an angel investor. And fourth, you can be service provider. This practice area. As of now, we have the 1 lakh startup. I know, Siddharth, in 1998, when I had one program on the Startup Manthan in Mumbai, the first program in the institute, there was 33,000 startups there. And the minister was Suresh Prabhuji, chartered accountant, and I invited him to the program. He asked me why you CAs are doing the this kind of program. I said, there's a reason. I asked them, what is the percentage rate of having successful in the startup? They said, 3 to 4%. Man, who's headed to this? Mostly IITs, IIMs. I said, sir, I know at least 60 to 70 chartered accountant. Those leading the startup or all are successful. So means that, any startup who headed, by the chartered accountant are 100% successful. So sir, immediately I request that this ecosystem can be taken over by the chartered accountant, because the IIMs, IIT definitely can be part of it, but there can be co-founder. Even the chartered accountant having the technology knowledge can be a founder and can take the lead also. And I believe that right now 1 lakh startups are there, and maybe in the next 5 years we're going to have 5 lakh startup. And the important role going to play by us by providing a financial due diligence, valuations, financial remodeling, and funding. All these areas require the consultancies by the chartered accountant. And they cannot grow the all startup. They need services. And that's why I'm urging that all people look at this area. We have started the certificate course on the startup. You can go through the startup.icai.org. We have the digital infrastructures for the funding, mentor, everything. You can enroll yourself, and you can also be part of the certificate course. So you can also learn various nuances of the benefits of the startup ecosystem. So with this, I think this is Katal Rejan. We're going to have a big program on 15th or 16th March in this particular startup city. And we're going to have a big event where the startup going to be funded. And like Siddharth Pai kind of, people going to take the lead. And I hope that, we're going to have good funding into the startup by the ICAI or the ecosystem, and request all your practitioners and your connect people to participate on 15th and 16th of March, and going to be a good show. And in recent startup fair in Mumbai, there were 8 unicorn led by the chartered accountant, and I'm hoping that in times to come, there are going to be 100 unicorn led by the chartered accountant. With this, thank you very much to be here.
Thank you, sir. Thank you for that address to the members. Before vote of thanks, I would like to felicitate our chairman for startup committee. I request all the dignitaries on the dais to do the honors.
Perfect. Thank you everyone for this opportunity to address the August gathering of Star Accountants in Bangalore on the subject of startups as well. I think right about now this is actually preaching to the entire choir, because as I was sitting here as well, I heard a number of people speaking about due diligence, data rooms, how to end up actually doing deals, what are the kind of M&A constraints that people have, etc. So I think I'm actually preaching to the end now as follows. I will actually be going through all the stages of startup funding, what are the kind of milestones that investors look at, what are the kind of market practices that people end up seeing in these particular matters. Next, I'll move on to how does funding actually occur, how do you value these particular companies as well, what are some of the limitations of the traditional tools of valuation that do actually end up affecting startups, and how the startup industry has slowly evolved its own set of rubrics and heuristics to end up actually valuing these sort of high growth, high burn, loss-making companies as well. Next, I'm going to end up going directly to the concept of financing, introduce you to what a term sheet is, break down the anatomy of a term sheet, what are the constituents of a term sheet, how are they actually valued, how are they negotiated, what the standard practices are, and finally move towards the closing the investment agreements, how the deals are actually consummated, what ends up happening there. I have deliberately not put due diligence because due diligence is something that all of us end up inhabiting fairly well. So I do actually want to concentrate on a number of elements, other elements that I do believe that chartered accountants should actually play a stronger and more outsized role when it comes to startup financing as well. So just starting off with an introduction and just the entire landscape of the entire startup ecosystem as of now. The entire startup ecosystem in India is a relatively young phenomenon, started by in the year 2011, 2012. So roughly in about 10 years, we've managed to galvanize over $141 billion of startups, done close to 1,200 odd M&A and exits as well, successful ones for that matter. We've generated 108 different unicorns, which is the third highest number of unicorn counts in the entire world. This is the net number of unicorns that exist as of now. Some of them, unfortunately, have actually ended up actually going down for a variety of reasons as well. There are 5,300 actually on the lower end of the number of startups who have actually been funded. And we have close to 100,000 or 1 lakh startups that are actually directly recognized by DPIIT as well. India is the third largest startup ecosystem in the entire world, trailing only behind the US and only behind China for that matter. But I think the important part to keep in mind is that the rate of growth of the Indian startup ecosystem is actually far greater than the rate of growth of what happens in the US, what happens in China as well. And the Prime Minister of the country has also articulated a vision that when India actually becomes a $5 trillion economy, the startups in the new age economy will end up contributing $1 trillion or 20% of that entire field. And that's something we as an industry have actually taken up and we're slowly working towards that as well. The combined market cap of these particular unicorns for that matter is about 345 billion. We've seen 18 successful startup IPOs happen as of now and a couple of unsuccessful ones. And slowly as we enter 2024, there are already 8 or 9 startups, out of which 7 of them are unicorns who've already filed their DRSP and the papers as of now will end up actually coming to the public markets as well. We have seen the number when it comes to seed funding, when it comes to total growth stage funding, when it comes to any of the valuation of unicorns as well. India is actually number 3 or number 2 when it comes to a large number of these metrics itself. If you look at the entire funding landscape also as of now, it's slowly slated to reach about $300 billion in the year 2030. This is despite whatever's happened with the dislocation caused by Ukraine, rising interest rates, what's happening in Gaza, etc. Despite this, we have seen, even though investors are pulling out capital from the rest of the world, investors slowly actually end up actually coming back to India as well. Though some of the funding numbers have fallen in recent times, I'll make sure to actually analyze the breakup of why that particular funding has actually gone down, what investors are looking at from startups, and what the new paradigm and the new playbook is when it comes to investing as well. So this is the kind of virtuous cycle and the virtuous flywheel that the entire startup industry ends up operating on. And $300 billion has actually done remarkable amount of work to improve India's balance of payments as well. So we look at the breakup of the startup investors or the typical startups over there as of now. The number of private equity and venture capital funds ends up being fairly smaller for that particular matter, but the numbers are slowly actually growing up over there as well. SEBI has about 1,024 different AIFs that are actually registered with them as of now, and the number of schemes they've actually launched is actually crossed about 2,000 odd schemes. The AF industry in the country is now a $100 billion industry. It's about 8.4 lakh crores in terms of capital commitments, and has grown at a CAGR of 112% from 31st December 2012 all the way to 30th June 2023 itself. And the one thing that's actually common amongst the entire startup story is that Bangalore is actually number 1 in almost everything that ends up actually happening over there for that matter, except barring angel networks and syndicates, which is the more informal way of actually funding these particular startups. Anything with regard to the more formalized or large scale funding as well as development has primarily been something that's happened in Bangalore itself. We have actually seen corporates and corporate venture capital funds end up actually coming into this entire ecosystem. The growth of accelerators and incubators such as the Atal Innovation Mission and the like, who's actually started doing a lot of fantastic work there. The Startup Seed Fund also has actually committed close to about 10,000 odd crores directly and indirectly to support these kind of incubators and the seed stage funding that is happening there. We're also seeing a large number of family offices. I'm fairly certain a number of your clients would have also reached out to you to understand what is this phenomenon known as startups, how do you end up actually investing, what is the best kind of deal, and what are the kind of protections they need to end up actually asking for. Because unlike the listed markets where there's parity amongst everything, the unlisted markets in the startup space is primarily driven by the primacy of contract. So it depends on the contractual terms, depends on the way it's actually written. The rights between two investors who may end up putting equivalent amounts of money may end up vastly differing as well. So there's a higher degree of due diligence and a higher degree of, I would say, expert knowledge that is actually required to adequately guide not only your clients, but also founders and entrepreneurs as they end up going through this entire journey as well. So as I was speaking about the global startup ecosystem, just put it in terms of comparisons as well. India is the third largest in the world. We're far larger than Israel, the UK, Japan, Germany, any of other comparable nations who are actually there for that particular matter. The reason why the US is still the largest is purely because of the fact that they happen to have the first mover advantage. The entire internet also for that matter was actually incubated in the US as a DARPA and a US government Department of Defense project. So they've actually had that sort of first mover advantage when it comes to it. And phenomenon of startups in India has been relatively recent in terms of which it's actually gone into the entire cultural zeitgeist as there. And China has also been the second largest in the world purely because it's been a very strong government initiative that the government has actually put in. And even we're actually seeing the cracks fall within that particular ecosystem as of now, as the world looks to pivot away from China and actually start becoming far more independent when it comes to that. Which is why the growth rate, which is the last line in that particular slide of 31%, is far higher than the growth rate of anyone else. But the hidden secret of the Indian startup ecosystem is that 85% of all the capital raised by Indian startups actually comes from foreign sources as of now. If you contrast that with India's mutual funds, there's 16,000 crores of SIPs going into the public markets on a monthly basis from domestic investors. Previously, when the foreign investor, in case Wall Street actually caught a cold, it would be India that would actually end up coughing. Right about now, even though FIRs have been pulling out a lot of money from the country, we've seen the stock market ends up actually being fairly resilient. India similarly needs a mutual fund movement to come up to its Indian startups as well, and to unlock the kind of domestic capital that is prevented purely as a function of regulation from ending up actually participating in this. So this to all the ICAI members and the Central Council members, there needs to be a concentrated effort from ICAI to end up engaging with government, engaging with the regulators, IRDI, etc., to give them comfort that investing into this sort of asset class is something that's going to be beneficial to the nation, as well as the kind of changes we need in regulations to enable Indian capital not just to only be a minor, an onlooker when it comes to this, but to become an active participant also in the startup revolution that's happening within the country. Now, if you look at the entire venture capital cycle as well, I've actually plotted this with regard to cash flow time as well as the stages that ends up happening there. Most of these stages are actually a matter of convention. There are no strict definitions of what constitutes an angel round, a seed round, a Series A, or any of your lettered rounds, or anything for that matter. But the regular pattern that they end up actually going is, normally there's an idea that's been conceived of by a few enterprising individuals who end up actually coming together. They end up actually, at that particular point in time, either bootstrapping it, which means they end up actually running it with their own funds, their own capital for that matter, or they may end up actually raising money from friends and family, or normally a few angel investors and the like. The term angel investor normally describes a person who has a full-time job or a full-time vocation, but looks to make certain selective type of investments into startups, just to act like a sort of angel to give them wings to end up actually growing up over there itself. So that particular angel investment and seed investment is slightly more institutionalized forms of financing that these companies end up actually going through. And as they raise this particular money, they try to achieve something known as product market fit. They try to gauge whether the entire market as a whole does actually understand and appreciate the products and services they bring to them, and how they can end up actually engaging with them a lot better. As a product market fit ends up actually getting fit, they end up moving to the stage known as the pilot test, where they end up actually testing it out in far larger markets, putting a lot more marketing dollars behind it, try to scale these enterprises as well. And as they become the sustained rollout, they end up actually looking for more institutionalized forms of funding, be it from private equity investors, venture capital investors, and the like itself. Slowly move on to growth, slowly move on to expansion, and ultimately either going to an exit by the form of an IPO, or an exit in terms of M&A transactions that can actually end up going through. So this is the common venture capital cycle, or the startup cycle that's across the entire world. I will break these cycles down into the constituent elements. What do investors look at? Who are the kind of investors that people end up tackling? What do founders also need to end up bringing to the table in order for them to attract this kind of financing and these kind of features as well? So look at the entire early stage fundraising cycle. So I'm going to break it between early stage, your growth stage, and then your late stage as well. The early stage financing primarily belongs to, I would say, incubators, foundries, and the like. We have actually seen concentrated efforts by numerous educational institutions, numerous other private enterprises, and the government as well, to end up actually encouraging the growth and proliferation of incubators and accelerators. And incubators as an organization that ends up actually bringing together entrepreneurs, giving them the kind of supporting scaffolding in terms of capital, in terms of advice, in terms of help, in terms of access to investors, access to market, access to any other resources they may need, help them to actually scale and grow these particular enterprises. After this, we have something known as your day zero VCs. These are normally very early or seed stage investors who, even if you have an idea or a PPT for that matter, end up actually funding you on the same, and end up actually giving you the capital to help to actually end up grow that particular idea as well. After this, and their normal check sizes are anywhere between $250,000 to about $750,000, which roughly comes up to anywhere between about 2 crores to about 7 odd crores for that matter as well. So that's the normal average check size that ends up actually predominating here. Next, we move on to the kind of pre-seed investments that often end up having the pre-seed and seed. These are normally, not every startup goes through all these particular stages. That is important. Some of them may skip day zero, go straight to seed. Some of them may go straight to Series A, etc. But normally when you break it up, these are the broad patterns and the broad buckets they end up actually falling within during that entire stage itself. And then as you end up going to seed stage for that matter, you end up actually getting seed specialists, micro VCs, and the like. So these are slightly more institutionalized investors. They're either structured in the form of an angel fund that's regulated by SEBI as a category 1 angel fund for that matter, or these are normally family offices, larger syndicates who end up actually coming together, pulling in money and to actually end up making these kind of investments and helping these entrepreneurs grow as well. So from this particular element, we start seeing the split coming in now, and we move on to something that the industry known as the lettered rounds. So these are just a naming convention that the industry comes in. These are normally your Series A, Series B, Series C, Series D, etc. You would have seen the likes of a Baiju, a Swiggy, a Zomato, any of them raising a large Series B, large Series C. Some of them are going to Series E and F and traversing the entire alphabet as they goes. This just actually shows the sequential number of rounds of capital that these companies actually end up ranging, and they end up actually going there. And the one thing that's important is, as a company grows, the number of investors ends up actually reducing, for that matter. Well, while they reduce, the average check size also ends up increasing considerably as well, because there are more sophisticated investors who demand a lot more of these companies, and they prefer to take slightly larger, more outsized positions on the cap tables of these particular companies, such as when these companies grow and become larger, they can monopolize a large chunk of the entire gains that actually end up coming over there itself. At this particular point in time, pricing doesn't actually become much of an issue. These companies have been fairly well established during then. They have a track record that makes valuation easier. And then they start looking at different paradigms of valuation, which I'll slowly speak about as we go through the presentation as well. Then as you end up coming to your growth stage, for that matter, these kind of companies end up actually diverging. So they either go to early growth for the same, or they end up going and they gravitate towards later growth also. We also start seeing the rise of M&A activity happening over here. The normal elements of M&A that end up actually going in no particular orders. Number one, there's normally an acquisition by a larger startup or a larger competitor, because capital has become one of the most effective moats, for that matter, especially in the zero interest rate regime that the world actually enjoyed for a substantial period of time, where the cost of capital was very low. And as all the CAs actually know, when you look at the discounted cash flow formula as well, if your rate of interest or the R over there ends up actually becoming zero or actually becoming very small, the difference between the value of a dollar today versus the value of a dollar 5 years later is more or less equivalent. So that was the entire thought process that actually provoked a number of large investors and capital allocators to start actually funding these high growth, high burn startups as well. So because their entire playbook at that point in time was, let's actually give these companies a large amount of capital, let them actually go conquer the entire market, create new markets for that matter, and become market dominant. And once they have dominance over the market, they can end up actually commanding pricing for that matter, and they can slowly start turning revenue positive, slowly start turning EBITDA positive, and hopefully PAT positive also over time. Which is why you notice every time you look at this one, the media headlines and the like, they always say that this particular startup has burned 3,000 crores, 4,000 crores, 5,000 crores, 8,000 crores, etc. So those numbers may seem very large, but given the fact that these larger investors were actually comfortable with this burn because of this paradigm I just said, it was something that was actually widely accepted and widely acknowledged as an industry-wide practice itself. But as we move out of the ZIRP, the zero rate interest regime that we've had for a substantial period of time, the value of a dollar today vastly differs from the value of a dollar 1 year later, 3 years later, 5 years later, and the like. Which is why the new playbook as of now is to no longer keep subsidizing growth for that particular matter, but is to make sure these companies become a lot more financially disciplined. These companies end up actually generating positive cash flows, and in case they're incapable to do so, to end up stopping financing, asking them to return capital, or to closing these particular companies down also. Recently, we've seen news of a fairly large BNPL fintech, which is almost a unicorn at one point in time, ending up shutting shop because the founding team had actually left. Investors also lost faith in that entire business model as they ended up scaling up. I think failure is something that I think most CAs can end up actually empathizing with because of the exam structure that we end up actually going through during our entire lives. But failure is something that the entrepreneur also ends up actually imbibing for that matter. There are numerous reasons why a startup can actually go wrong, which is why even when they fail, no one actually takes them to task, no one actually holds them accountable for that, no one actually has anything bad to say about them. They celebrate that failure because they get back on that horse, they start up another business and they go. The world that startups inhabit is inherently defined by uncertainty. And that particular uncertainty at that point in time can affect them, even though the uncertainty gets de-risked as time actually goes by. It is common knowledge that the uncertainty exists even as they become larger companies as well. So I think one of the most effective roles that a chartered accountant can play over here is to sort of numerize that particular uncertainty that exists, put a number behind it, and create a sort of risk management frameworks and guardrails that prevent these startups from actually end up going through and actually failing for that particular matter. Now, when you break down the kind of startup funding stages also during this entire field, as you actually go through as well, there are actually certain elements that investors end up actually commonly looking like. So in case a company does actually want to, I would say, leapfrog some of these particular stages, they have to more or less conform to what the investor expectation is as of that particular time. And that investor expectation may differ from investor to investor, from sector to sector, and from stage to stage as well, for that matter. Now, if you look at the startup stage itself, the startup stage is more about exploration and discovery. So they're normally smaller experiments that they end up actually running. These companies pivot or change their business model, change their revenue monetization strategy, change the industry they operate in also during that particular point in time. And whatever money they raise is purely for the purpose of experimentation as they end up actually scaling it up also. As they go towards the startup stage, or normally in their seed funding, they should be in a position to end up actually launching their particular product, getting the first few paying customers, or at least a large number of non-paying customers at that particular point in time. They end up fleshing out an entire team, actually normally at that point in time, they end up actually engaging a CA with them to help them in their fundraising, help them in their accounts, help in their compliance, and the like itself. And they end up actually developing a lot more for the market as they end up actually scaling through. Now, as you come to your lettered rounds and your Series A's, as I said, you need to have a working business model at that particular point in time. So there has to be a monetization strategy that exists. There has to be a certain amount of traction. There has to be recurring revenue that ends up actually coming in. Or your customers, based on your customer acquisition cost, a larger number of customers need to actually come back to you, start transacting more with you. So you have a larger wallet share of what they end up actually doing at that particular point itself. And it's at this point in time where most of these particular companies enter what is known as the startup valley of death. So the startup valley of death is actually an industry term which actually speaks about in case these particular companies end up actually reaching a certain stage where they do actually have some level of product market fit, but they're unable to get growth. More often than not, the larger investors who come in become more discerning, and they don't actually end up funding these particular guys as of now, which is why we've seen a large mortality rate, or the rate at which startups actually end up actually failing. And normally, this entire business cycle happens within a span of about anywhere between 1.5 to 3 years for that matter itself. And this is where the highest degree of uncertainty actually exists, and the mortality rates and the figures have actually given up to you. Close to 50% of all these particular new age startups during their first 3 years will actually end up failing. So we've actually seen this very stringent Darwinian curtain that ends up actually falling with every stage, and this ends up actually filtering startups as they grow, as they scale up, and they become larger. So out of 100 odd companies who may be there, it may only be one who ends up actually IPOing on that particular part in time. So it actually shows how competitive this entire industry is, and how unforgiving it actually becomes as these companies end up actually scaling over there itself. The Series A is normally where larger institutional investors come in, private equity funds, venture capital funds, very large corporates and the like, who end up actually coming in for that matter, and they get a lot more demanding about what they expect from these particular companies as well. So if you are speaking to any of your clients, if you're talking to founders and the like, never look at your previous fundraising experience as a proxy for what's going to happen in the future. Your angel round, your seed round will be the easiest round you end up raising because it's friends and family, usually a lack of documentation. It's more an act of charity than it is an act of capital allocation or an act of investing itself. But as they become larger, the market gets a lot more unforgiving, the market gets a lot more demanding of these particular companies as well. Then as for the few successful companies who manage to actually scale up and become larger, the average valuation ranges are also given up here to show you what are the kind of valuation expectation investors have, what can entrepreneurs end up expecting from the market, and who are the kind of people they can actually end up tapping to at that point in time as well. And as you grow and you scale your business, elements such as M&A, geographic expansion, internationalization, getting into adjacent business lines, etc., all become very, very important parts of the entire calculus that is actually there. And at this point in time also, the diligence actually moves from just looking at your filings, looking at your statutory filings and the like, to actually dissecting the entire P&L stack, understanding what your cost drivers and revenue drivers are, where margin expansion can end up actually happening in the future, what are the kind of teams that you have, what are the incentive structures that you end up creating, how do you align founding team and management team incentives to what shareholders and investors end up actually demanding. And this is where I actually believe that startups actually move from, I would say, computer engineering to actual financial engineering at that point in time, because most of the development and the investment into tech would have already happened at that point in time, and they need to end up actually creating the kind of processes and frameworks that enable them to end up actually growing and becoming far larger as well. And as they enter their seed round, most of these companies end up becoming acquirers by themselves. Some of them may end up actually planning their IPOs. They may end up actually planning to acquire some of them, consolidate, go through the NCLT process, become much larger, and start actually charting their IPO plans also as they end up actually scaling over there as well. Now, if you break down the entire startup funding stages, what I just said across the entire part, if you actually look at it from an acquisition perspective or the exit perspective also, acquisitions and M&A becomes the most common exit route for almost every startup who's actually there. Very few of them, as I said, get filtered out and end up actually IPOing for that particular matter. But I think as of now, we've actually seen the likes of stronger IPOs, and given the market appetite for IPOs as well, a number of startups want to end up actually hitting the public market as opposed to going through inorganic M&A at that particular time also. And mind you, a large amount of the M&A that actually happens is more often than not happens in stock. So the ultimate cash of financial liquidity that happens for the number of these investors as well as the ecosystem takes a substantial amount of time. Flipkart bought close to 100 odd companies, primarily for stock, some of them for cash, etc., before they were ultimately bought over by Walmart, marking a $20 billion exit, which is the largest exit that the Indian ecosystem has actually seen as of now itself for that particular matter. But what we are seeing from the public market as of now, the public market has gotten a lot more discerning on the types of startups that come in. And EKG startups have already come in fully baked in terms of their valuation as well. Most of the public market investors tend to actually shy away from them because they want to see the same kind of aggressive growth that has punctuated the startup journey continue as they actually reach the listed market space and all as well. Now, if you break down the entire fundraising in terms of numbers also, you'll actually see a very strong trend actually emerge over there, where the latter half of 2021 and the first half of 2022 actually end up seeing the largest fundraising numbers. This was purely driven by the fact that central banks across the world slashed interest rates down to zero, and a large amount of free capital ended up actually flooding the entire market. There was a massive liquidity glut. So just to break that down as of now, the yields on fixed income investments actually started coming down to zero almost across the entire world. So we actually seen investors in fixed income end up actually moving towards equity, and investors in equity who were actually chasing alpha slowly make their way towards startups. And several bold, intrepid folks actually go all the way from startups to crypto as well. And that's why we see when interest rates have actually risen over time. The first market to fall was actually the crypto market, followed by the startup market. Then the public equities also started collapsing, and that's when a large amount of money started going towards US Treasury bonds and government securities and the likes itself. So a flight to safety has sort of punctuated the last 3 years of the entire startup ecosystem also, which is why you look at the number of deals, look at the amount of funding that's happened, we've seen that kind of collapse actually end up punctuating the Indian startup story. Now, the hidden feature behind this that not many people actually speak about is the fact that a number of Indian startups don't necessarily have to end up actually raising these large amount of funding as they end up scaling as well. Their business models have gotten a lot more resilient. Many of them are still sitting on the cash piles that they raised in the year 2020, year 2021, and the first half of 2022 also. So they need to tap the market, raise more money, raise more capital, ends up actually reducing. And a number of them, as of now, are looking to actually start reducing their burn, the amount of cash they end up actually spending on a monthly basis, and look to turn more profitable as well, and reduce their reliance on startup funding. So even though the headline figures always speak about the dip in numbers, no one looks at the quality of spend or how the money is actually being invested by these couple of companies as they go there also. In fact, June 2023 was actually the worst year for startup funding when you actually break it down over there as well. And this was also exacerbated by what's happened in Gaza, Israel, also for that matter, which has actually affected investor sentiments. And even as of now, the funding winter that's actually ongoing will only end up resolving by about the end of the first half of next year. Because in 2024, there are 3 large major economies across the world who are actually going to go into election time as of now. One is India, then it's going to be UK, and then it's going to be the US as well towards November. And in times of political uncertainty at that particular point in time, most investors tend to end up actually choosing to conserve cash as opposed to take the kind of risk that you need to end up actually investing also. So this is further exacerbated and reduced the kind of funding expectations that investors end up happening over there as well. Now, if we look at the fundraising sectors, or the hottest areas that Indian startups end up actually operating in, it's actually predominated by fintech and e-commerce as of now also. And e-commerce, if you notice over time, the numbers are actually reducing. Because what's happened is the market has actually reached a certain stage of maturity. We've gone through waves and waves of consolidation now, and the clear winners have actually emerged. Flipkart is now owned by Walmart. Amazon is still actually very large over there. Snapdeal is yet to end up actually picking up since they went through a large amount of turmoil 5-6 years ago. And I think Meesho is the one that's actually coming right now to end up actually scaling. And even within e-commerce as well, you're seeing the rise of what is known as verticalized e-commerce, such as food delivery, provision of services and the like, end up actually coming there. So your Zepto, your Dunzo, and a number of them, the degree of competition is high. And the reason why they've had to raise so much money is because the OPEX-heavy model that they end up having actually requires them to plow billions and billions of dollars of capital in order to conduct continuing operations itself. Fintech, I think, on the back of the India stack, which is the creation of digital public goods, your Jandan, Aadhaar, Mobile, UPI, RuPay cards, etc. All of them is actually daisy chained together right now to allow investors, to allow fintech companies to start actually giving credit to as low as 100 rupees a day to deserving people, allowing investors to invest into mutual funds with as low a ticket size as 10 rupees for that particular matter in a nearly frictionless way. So we have actually seen great investments by the Indian government as well as the private sector into this, sort of supporting the entire startup story and evangelizing these sort of the public investments and across the entire nation. If you look at the fundraising in terms of stages also, seed stage is actually where the largest amount of activity happens, but they're normally the smallest ticket size as well, which is why you've seen the number of deals actually ends up being exceptionally high, and the average amount of money also they end up actually raising may not actually be as much, because the amount of money that's there in seed because of high uncertainty is normally much lower, and close to 50% of these companies may not actually end up surviving and end up actually raising subsequent rounds and all as well. Which is why the growing market uncertainty has actually prevented a number of investors from actually deploying into these particular areas, and we've seen the kind of plunge that has happened as of now from your seed funding as well as the pre-series A as well. If you look at your late and growth stage funding also, we've seen those numbers actually crater to a very large extent. This is because when you start comparing some of these startups to their listed market counterparts, you end up seeing a very, very wide divergence in terms of the fundamental ratios and metrics we use to analyze these particular companies as well. If you look at the PE ratio, it's one of the most common ratios that public market investors end up using. The private equity ratio, these startups become very, very rich by their entire comparison itself. And as interest rates have actually reduced, there is a greater degree of choice that the investor has. So most investors are choosing to allocate it towards more traditional, stronger growing businesses with strong operating cash flows, as opposed to high growth, high burn, which has actually fallen out of favor as of now itself. And that's why we've actually noticed the rise of bridge financing or mezzanine financing. Bridge financing is nothing but financing between two later rounds or between two larger rounds. Now, the constituents of bridge financing actually include, number one, the ticket size being far lower than what you would traditionally see in these larger number of rounds. Number two, normally these rounds are done by internal investors, normally through a rights issue, or they end up actually doing it. Existing investors end up participating. No new investors come into that particular field itself. And the third part, which I believe is the most important, is that valuation is not actually decided at that particular point in time. The valuation is actually deferred to a later point in time in the future because of the high degree of uncertainty that ends up actually punctuating this particular stage. So we've seen early stage funding numbers drop, we've seen late stage funding numbers drop, we've seen bridge financing actually become far more preferred for that matter, which shows you the kind of mood and the kind of uncertainty that's actually there in this itself. But one thing in the fundraising element that I think most of the media ends up actually missing out is while startups aren't raising as much money, investors investing into India are raising the highest, largest funds that we've ever seen as of now. This is known as dry powder. It's unallocated capital that are investors yet to end up investing in any sort of startup. And we've seen that 126 funds have actually come up in the year 2022, sitting on a large amount of dry powder as of now. There's a Goldman Sachs estimate that actually puts close to $60 billion of dry powder waiting to end up getting deployed in India, playing upon themes such as Digital India, Make in India, China Plus One, and these sort of shifts itself. So it does actually stand to reason that even though funding numbers have come down, investor sentiment in the country still remains bullish, and the moment the macro factors pick up, a large amount of capital is going to end up getting flooded into these particular areas, and they are going to end up actually growing as well. Most of these investors, like I said, have taken up a sort of wait and see kind of approach. They are actually looking at their later stage investments. They have noticed that the market has gotten fairly overvalued as of now, and everyone's now hunting for a fair valuation at that particular point in time. So it's become a game of brinksmanship as we actually go through. It's between the entrepreneur and the startup who has a large amount of cash on the balance sheet, looking to cut down burn, conserve money and turn profitable, whereas investors are sitting on a large amount of money that they have to end up deploying within a certain amount of time. I think 2023 is when we've seen both these elements be at odds. 24 is when we're going to see them converge, and the entire virtuous cycle end up actually picking up and scaling up as we go there as well. Now, coming to the element of valuing startups, which I think is also a very important element there, because there's a large amount of, I would say, misinformation that's actually punctuated the market as to how they end up actually looking at these particular startups and why certain startups get a high valuation, why some of them get a low valuation, and the like itself. So to this, I actually want to take a very important quote from the Professor Aswath Damodaran. He's actually said that when you look at these early stage companies and these startups who don't have an operating history, operating in an uncertain environment, where there's no market or there are no comparables for that matter, it makes it next to impossible to end up actually valuing these particular companies and doing everything over there itself. Even astrophysicists, rocket scientists, smartest people in the world can never actually discern or divide what goes into the valuation of a startup and everything that's actually there as well. Now, the reason why valuing these particular early stage ventures is tough as of now is because of these seven elements that are actually there. And this is something that all of you, as you do evaluations as a registered valuer for any of these rounds of funding, secondary transactions and the like, you would have actually seen these kind of elements actually play and actually inject a degree of material uncertainty into the kind of assumptions you end up actually taking. The lack of an operating history means that whatever figures the founder puts into an Excel sheet ends up actually becoming the truth. Now, all of us know in this room that you can put an Excel sheet as number, actually refuse the number. So it's very easy for anyone to actually put and say, in year 0, I'll actually get 100 crores, year 2, I'll get 1,000 crores, 10,000 crores. I believe life is a linear equation that way. And we have actually seen this sort of unbridled exuberance end up actually resulting in measures such as angel tax or Section 52(7)(b) end up being created by the government to prevent these sort of unbridled expansion from end up happening and also prevent untoward elements from using startups as a via media for laundering money by injecting into very, very high valuations itself. The uncertainty that exists, no operating history, the uncertainty that exists, the lack of comparables for that matter, the illiquidity of the investments as well, where it's unable to actually achieve the price that you actually invested in. There is no active secondary market like a listed market for the same. It makes valuing these particular startups and everything exceptionally hard as of now. That's why your traditional valuation methodologies, your discounted cash flows, your book value methods, your comparables and everything end up actually falling short when you actually end up applying this. That's why it's important as finance professionals to also end up advising your clients to be more realistic about the kind of valuation expectations that they have and to sort of backtest these elements using new methods, some of which I'll actually end up speaking to you as we end up actually going there as well. Now, even when you look at valuing these particular startups also across any of the stages that are there are certain characteristics that people need to end up actually looking at as of now that do lead them to how you can end up actually valuing these companies and actually putting them as well. So it's broken up between seed, idea stage, seed stage, early stage, growth stage, expansion, etc. And if you notice that for the earlier the stage, there's a lack of almost any indices or indicators as to how this particular business can actually end up growing, which makes valuation near impossible at that particular point in time. So the industry has evolved a method now where they defer the valuation through the use of convertible instruments and the like to a later point in time, which allows these companies to raise capital, to end up actually growing into their business model, developing a business model for that matter. And then when they do actually have a bit of an operating history, when the uncertainty reduces, then at the very next round of funding that happens at that point in time, there's normally a valuation that's ascribed, and then the valuation is actually back calculated by the earlier investors who end up actually coming over there itself. If you look at the cash flows also for that matters, normally in the later stage that these companies actually become cash flow positive also. So DCF becomes a very hard choice to end up incorporating here, despite what Rule 11UA of the income tax rules may actually say, saying that a company can only be valued at NAV or DCF. In fact, as an industry, we've actually been speaking to the government on numerous occasions to tell them we need a wider variety or choice of valuation methodologies for that particular point in time, because the current set of valuation methodologies fail when applied to these kind of startups, and there's empirical evidence for that particular failure as well on the same. So the proof of concept also ends up actually getting fructified as a company actually grows. Historical data is normally very limited as these companies actually end up growing over there, which is why you end up actually seeing these kind of methods that come in. So the fixed range methods, the fixed ranges, cost approach, and scorecard evaluation method, these are commonly methods wherein people actually look at the replacement cost of these particular enterprises. They either use predefined ranges of valuation depending on the pedigree of the founder, the space they're operating in, the kind of competition that exists over there. A large number of intangible factors need to actually end up getting converted to numbers in order for us to end up actually arriving at a valuation at that particular point in time. So the scorecard also, these are more bespoke metrics that larger investors, large angels, micro VCs, VCs and the like end up actually using to end up valuing these particular companies as they end up actually going through as well. Now look at the valuation. Most of the valuation of a startup actually derives purely on the top line that these companies end up actually generating, which is why you look at revenue multiples. No one actually goes down the entire P&L stack. They look at the revenue multiples, they look at the function of GMV, they look at the number of monthly active users, daily active users, gross transaction value, etc. They look at a number of alternative metrics that you don't traditionally use to end up valuing later in growth stage companies that are there as well. If you look at the valuation of some of the companies that are there also as of now, I have actually charted out some of the revenue multiples of fintech companies, logistics companies, and the likes itself. Some of these multiples, for that matter, end up being as high as about 75. So 75x on revenue, it may make a lot of people end up balking, for that matter, but there have been numerous SaaS companies in the country who have actually been valued on that particular metric itself. And India actually has one of the highest valuation, or used to have one of the highest valuation multiples across any of the traditional metrics that people actually, that investors end up actually looking at for the same. So we've seen that because traditional methods have ended up failing, these sort of other heuristics such as top line multiples, etc., end up actually coming through. And then as the company grows and becomes more sustainable, the more traditional elements end up actually coming and playing a stronger role when it comes to valuing these particular companies as well. So right about now, as the startups end up actually growing and becoming larger, the startups, there's slowly a change in the entire investor expectation right now to start looking at profit multiples, multiples on EBITDA, multiples on gross margin, as opposed to purely revenue itself. Because it's fairly easy to spend 100 rupees to gain 100 rupees of revenue also. And this is something that now that interest rates have actually risen, even investors have slowly wisened up, and as the cost of capital has increased, there's actually greater demands being made of these particular startups as well. Which is why if you look at the public cloud index, this is what's actually happened in the US, for that matter, except for the COVID period where we've actually seen this sort of large-scale expansion of multiples that happen. As COVID has actually gone down, we started getting more towards a slowdown and a global slowdown. The valuation multiples have actually compressed over time itself. So the correction that has been there as of now has actually come through, and this is known as a reversion to the mean. If something ends up actually exceeding the mean or the normal trend line for these particular companies, it becomes fairly, over time ends up actually correcting it and bringing it back to the mean itself. So when you are speaking to your clients, evaluating startups as well, plot them across the average valuation ranges for these particular companies in their same cohort itself. Databases such as Traction and the like do actually end up playing a very strong role in terms of giving you this kind of information and shedding a lot more light when it comes to these areas. So make sure to use up these more public resources to end up actually advising your clients how to value these companies and whether something is overpriced or underpriced over there itself. So next, when you end up coming to the investment documentation, so we've gone through what are the stages of a startup, what do investors look at that particular point in time, how are they valued, what are the alternative valuation methodologies that people end up using, how it's primarily a conversation-driven or negotiated valuation process. We'll now slowly start moving towards the investment documentation and how do you start navigating funding these particular startups also. And these are terms that you would have normally seen, a term sheet being signed, term sheet being pulled back, and your clients would have also come to you with this. So this should hopefully give you enough background information to be able to advise your clients on a number of these matters, rather than send them over to a lawyer or someone to end up actually looking into these particular areas as well. Just split this sort of investment documentation between two broad practices. One is the American way of doing it, which is more elaborate in terms of their documentation, but covers the same points, and the Indian or the rest of the world way of actually doing it, which is a simple standard set of documents and terms that investors actually end up looking like also. So the term sheet, which I'll speak more about, the term sheet is more an indication, an expression of interest for the same. It's a document by the investor and the startup which points out the salient terms of the proposed investment, like what the valuation look like, how much money are they putting in, what are the instruments they want, what rights do they require, what is the board seat they end up getting, when that may fall away, what are certain matters that the company may proceed with, can only proceed with once they get the consent, prior written explicit consent of that particular investor, as well as the governance rights that end up applying over there. Next, you come into something known as a shareholders agreement, and the US has a different version of this. The shareholder agreement is basically a contract which gets entrenched into the articles of the company, which speak about how the company should end up actually conducting itself, at what points should they end up actually seeking investor consent, what acts can the company do, can't do, how the company is going to utilize the money, and how the company is going to end up actually scaling forward also. This also deals with numerous issues such as transfer of shares, transmission of shares, raising the next round of funding, who has the right to participate, can you end up actually buying the securities of existing investors, what happens in case there's an event of default, etc. And I'll break down these terms to you as we end up going through this entire process as well. And the last part becomes the share purchase or the share subscription agreement, But a substitution agreement actually speaks about the actual investment into the company. What are the conditions precedents? What does the company have to do? How much due diligence has to complete? What are the kind of corporate filings they have to make? What are kind of cleanup they have to do before they invest? The process of investment itself, when there's a standstill for these particular companies, how do they end up using the money, when the allotment needs to happen, what is the mode of allotment, etc. And then conditions subsequent, which actually speaks about what the company has to do for the next 30 or 60 days after the investment to make sure that everything is actually done and the company can start beginning operations as usual itself. So everything that I spoke to you about a shareholders agreement, for that matter, also does exist in the US, but they break it down between 4 other documents as of now. Your corporate charter is the same as the articles of association of a company. It talks about what the company can do or can't do. Investor rights talk about the rights that the investor has, the right to a board seat, right to participate in transfers, how they end up actually managing, any special economic rights they have, participation rights, etc. The voting agreement speaks about what are the matters they can end up voting on, what are the kind of voting percentage they have, whether there are any super voting rights or the like itself. And the ROFO agreement is the right of first refusal. In case there are any transfer of securities by any, because you're private companies after all, there is no free transferability of securities that exists. So what are the kind of restrictions that end up applying over here form actually part of the ROFO agreement? Normally all these are consolidated into one agreement in India and the rest of the world, but the US prefers to end up actually splitting them into 4 different agreements, and they have a separate process for that itself. Good. Then I come to a term sheet, and the term sheet is one of the most, I concentrate a lot more on the term sheet as of now, because the term sheet becomes a mother document through which all the other investing documents end up actually flowing through on the same. I've actually written an entire booklet on term sheets also, with the published along with Inc. 42. These are the salient terms of that entire term sheet, which I do believe is important for anyone looking to invest in startups to end up understanding of that as well. So when you break down the anatomy of a term sheet, it's basically split between your transaction details and your rights. The transaction details talk about, like I said, the valuation of the company, how much money they're raising, what the shareholding is going to be, what the company has to do before investing, during the investment, after the investment, what are the indemnities, the reps and warranties, what are the kind of promises the startup is actually making in terms of its corporate constitution, in terms of its filings, in terms of due diligence, etc., that the investor can actually end up relying on in order to make that investment. Then you end up actually having other clauses such as your no-shop clause, which means you can't take this term sheet, go to another investor and say, look, investor A is giving me a valuation of X, can you give me 1.5X or 2, or shopping that around? We actually prevent that from happening. Exclusivity, which means that you'll only engage with a certain set of investors for your proposed fundraise. Breakage, which means in case the deal doesn't go through, what are the costs associated with it, who has to bear those costs, etc. And a non-disclosure agreement to ensure that there's no publicizing of the documents. When you look at the rights, these are the similar kind of rights that any shareholder has. Economic rights talk about what happens in terms of an exit, what is the kind of, what a kind of dividend, etc. ends up applying there. Participation allows you to participate in future rounds of financing. Control speaks about your board rights, what are the kind of restrictions you're placing on the company in terms of usage of funds as well as operations. Transfer speaks about any transfer between 2 shareholders. Governance, voting, and information are fairly self-explanatory. Investor protection talks about the list of matters that you need to get investor consent before you end up going, regardless of when they have a board seat. Unlike a public limited company, which is primarily board-driven, a startup is not a board-driven company until it becomes much larger. Normally, everything is actually done by the management, by keeping the investors informed as well. And some managers or investors may not want to actually get anyone onto the board of directors, obviously for the liability reasons that actually exist for a private limited company in this country as well. And removal talks about how the management may be removed, how it can be replaced, and everything over time. Now, just the basic tips on a term sheet. Number 1, a term sheet is not a legal document, for that matter. So you don't actually need a lawyer to end up drafting a particular term sheet itself. There are numerous drafts of a term sheet which in very simple language and in layman terms actually explain all these particular matters. And once there's consensus ad idem between the investor and that particular founder, then it makes it easier for the lawyers to come in and draft the rest of the agreements that are there itself. Number 2, there is no prescribed format of a term sheet. You can have a term sheet which is as small as about half a page or even done on a napkin. In fact, Dunzo, the very first round of Dunzo was actually done by an investor who wrote down the term sheet on a napkin in a cafe in Bangalore, gave it over to him, and then they ended up actually financing that itself. I happen to know the founder and the investor who did that. So there is no prescribed format of what it ends up actually, a term sheet ends up looking like. All you need to do is ensure that the founder and the investors end up agreeing on what the salient and material terms are, and the rest of the documentation and everything ends up actually following over there itself. And when you break down the anatomy of a term sheet as well, the typical clauses that I spoke to you about, these are the normal 10 or 11 clauses that you end up actually seeing in almost every term sheet also, some of them in different names and the time itself. So the preamble of the term sheet is simple. It just states that the term sheet is actually non-binding for that matter, because it's written in simple terms. Some of the terms aren't defined. It's just a statement of intent more than it's a valid legal document that you can end up actually enforcing for that. It's not considered as an offer because of the Contract Act of India as well, but it's considered more an expression of interest on the like itself. And normally all the terms in the term sheet are detailed out and fleshed out in your definitive agreement, shareholders agreement, subscription agreement, etc. And there are certain terms of the term sheet which survive its termination once it ends up actually lapsing as well. Now the question you'll obviously ask is, why am I actually placing so much faith on a piece of paper that is actually not enforceable? It's simple. The term sheets are not binding because it's purely a statement of intent. Because unless an investor does due diligence, it can't necessarily underwrite an investment with that particular company because there may be material risks that actually exist over there itself. So they say, look, so long as you walk the straight and narrow, you do these kind of elements, we will actually go out with the investment. But if you fail any of this, we have the right to end up actually pulling out, which empowers the investor to explore the deal in greater detail and gives the promoter comfort that these are the preconditions for the investment. And so long as you meet that, the investment will actually end up actually following through. And that's why it's subject to a variety of conditions and preconditions and the like. Now, should you sign a term sheet? The answer is actually, it's not necessary, but it's always good hygiene and good practice to end up signing a term sheet, such that if there is any misunderstanding between the principles involved, you can always rely on the term sheet to say what that particular common understanding was at that point in time. And coming to the binding clauses of a term sheet, they're normally exclusivity, validity, expenses, and confidentiality. So exclusivity means you can't use the term sheet and go shop around and ask other people for more. Validity means it's valid for a certain period. If you don't complete the deal in that certain period, it automatically terminates. Expenses are, obviously, there would be some expenses incurred. Who pays what share of the expenses? And confidentiality means you can't go out to the wider market or to the public or even to the press with that particular term sheet, because until a deal is closed and everyone signs off, you need to maintain confidentiality about that. Now, coming to the next element of valuation, dilution, and securities as well, the very fundamental formula that underpins all of investing and startup investing and the like is actually this. It's simply that the pre-money valuation before the investment, plus the investment from the investors gets you the post-money valuation of the entire company. Even though it sounds fairly simple, this is actually the fundamental underpinning of all valuation exercise and price discovery that the entire people actually go through. So the pre-money valuation is a valuation of the company before the investment. So the value of all the work that's gone on, the pedigree of the founder, the IP they've created, the team, the revenue, etc. Post-money valuation is the value after the particular investment, and the investment is valued at cost itself for that particular matter. So if you break it down into an example, there's a 9 crore pre-money, there's a 1 crore investment, it's a 10 crore post-money for that matter. So the investor owns 1/10, 10% of the entire company at that particular point in time. Now, we're coming to the type of securities. Even though we're using the listed market only to equity securities, the unlisted market has a wide variety and bouquet of securities on offer as of now. The most common in that order are actually CCPS, compulsory convertible preference shares, compulsory convertible debentures, equity shares, and convertible notes. CCPS are the most preferred form of instrument because it gives you preference in terms of dividend, liquidation, and economic rights over the equity shareholders. And normally founders hold equity, investors own preference shares, and normally they prefer to maintain these preference shares as they end up actually going through. So preference shares by design and through statutory actions actually do have a higher valuation and command a higher premium compared to unlisted, compared to equity shares, that's itself. CCDs are primarily used to defer valuation to a later point in time in future, or you want to secure your statutory right of a higher priority in terms of distribution. CCDs become the preferred mode instrument over there. Equity shares are held by ESOP holders as well as founders. Convertible notes are a simple, effective design to defer valuation to a later point in time. Now, in terms of your condition precedent and subsequent as well, these are the normal statutory stuff that I'm fairly certain everyone in this room is going to be familiar with. Completion of due diligence, review of all the transactions that have happened, review of all the board minutes, meetings, statutory compliances, any information requests, changes to the articles of the company, existing documentation, etc., and any other such matters. So these are some of the hygiene points that are there, that depending on diligence findings, you may ask them to correct it before your investment, maybe after your investment. You'll end up actually fleshing that part out as time actually goes by. And your conditions subsequent arise purely as a function of your diligence and as a kind of cleanup work that the company has to do as the company ends up actually closing a round of financing and scaling up as well. The economic rights are the most heavily negotiated of all the rights over there. The common economic rights that investors seek are actually the right to exit. So they have to be able to exit that particular investment within a defined time frame, normally anywhere between 4 to 6 years for that particular matter, and they give you an indicative rate of return. It's not an underwritten rate of return, but it's more an expectation as opposed to something that's going to be very binding on everyone involved. Next, you have something known as a liquidation preference, which I'll speak about a little more in detail, down round protection, as well as some of these. So I'll break all these terms up also fairly briefly, so we'll wrap up also very quickly on this as well. So the exit avenues, like I said, exit via an IPO, secondary sale where you sell it to an existing or incoming shareholder, exit via strategic sale or M&A to any sort of third party who ends up actually coming in, exit via buybacks, which are not as prevalent because it requires a higher net worth and profitability criteria that are harder for most companies to meet under Section 68 of the Companies Act. And something known as a drag-along right, where if you're unable to find an exit for the company, you sort of drag along all the shareholders, find a buyer, and compel everyone to end up actually selling their securities to that particular buyer at an agreed-upon price. The liquidation preference also, it primarily determines how exit proceeds are actually distributed amongst all the shareholders and the investors in the company itself. Now, normally the liquidation proceeds, this is the standard language that you put, in terms of a liquidation event, which is unlike a statutory liquidation, which is an NCLT process. Liquidation in the startup world means any sort of exit event that ends up happening. The money is normally distributed either where investors either get all their capital back or they get to participate pro rata in the remaining proceeds. This is known as a 1x non-participating liquidation preference and is common across the entire industry. You contrast this with the participating liquidation preference where the investor gets to double dip, which is they get to get their principal back and they get to participate pro rata according to their shareholding in the remaining proceeds of the company, the remaining exit proceeds that are actually available there. A down round is a round that happens at a valuation lower than the latest valuation of that particular company, which is that we've seen a lot of down rounds happen as of now because the market has also cooled down. And the kind of protection is there is twofold. One is full ratchet, where assuming the investor invested at a lower valuation, what are the number of securities they have, versus broad-based weighted average, which takes a weighted average of your shareholding before and after that particular investment and sort of normalizes it after as well. Most of these terms are widely well known. If you actually Google it, you'll actually end up getting the kind of statutory and customary constructs on the same. Coming to your control rights, the core principle here is the investors do not invest in the company for the privilege of running it. They are purely looking to secure their economic interests and their rights in the company while giving flexibility to management to conduct the operations of the company in whatever way they deem fit. The control rights are normally either a board seat or a board observer seat. Affirmative rights, which are certain matters the company can't proceed with, regardless of if shareholders approve or the board approves. Without the investor approving it, there are certain things you can't end up actually going through as well. And the approval of the use of capital, that means how you're going to use the money, etc., as part of a business plan, requires that. Your affirmative matters, I'm just going to broadly go through these. So these are primarily any large-scale, non-operational matters require investor consent. So any change in the capital structure, any change, any divestment or significant investment into other areas, any amendments of the rights of the shareholders, certain regulatory matters, and significant changes to operations require the prior consent of the investor because these companies don't generate cash themselves. The investor has a role to play in how their capital is going to be invested by that particular companies into operations itself. Information rights also are fairly simple. It's just what information you want from these particular companies at what frequency as well. Transfer rights investing also, these are normally split amongst three: investors, founders, key management, and other shareholders as well. And the mechanism of the transfer also split between two. So normally there's something known as a restriction on the transfer, which is a right of first refusal or right of first offer. And both of them end up differing in how you end up seeking consent for that particular transfer as well. And the right to exit with these transfers known as a tag-along right. And normally when you look at the founder, the transfer restriction applies, there are restrictions on the ability of the founder to liquidate their securities because the founder needs to maintain skin in the game and they can't end up raising money at a high valuation and they're running away from the company. They have to end up working with the company and delivering upon the business plan they've given to investors. And they normally maintain a sort of liquidity pool, which is a small amount of shares, usually 5% that the founder can sell for liquidity purposes, normally for estate planning, for schools, for any medical emergencies, etc. And something known as reverse vesting. Now, even though the founder may hold those particular securities in terms of physical possession, the legal title ends up only vesting to them once certain conditions are met, normally either revenue milestones or their time base itself. And this helps to maintain the alignment of interests amongst everyone, then understand what the transfer restrictions and these particular things are. Now, indemnities, reps, and warranties also, these are primarily going to be for, I'm just going to walk through them really quickly. The reps and warranties are primarily assertions of fact, saying that my company has been validly constituted, my share capital is so much, here's my operations, here's my stuff, etc. That an investor can rely upon in order to make that particular investment on the same. And the indemnity is a sort of statutory or legal recourse the investor has in case, God forbid, something actually ends up going down. Now, the reps and warranties are also split, normally between fundamental warranties and other reps. Fundamental warranties are warranties that are fundamental to the investor going ahead with it. These are normally statutory in nature, and it's a sort of binary decision, it's a yes or no. If there's something materially wrong with the company, no one wants to invest in it because a majority of the capital will go into actually clearing out existing liabilities. The other reps are normally capped in terms of the investment amount, so founders and the companies don't go out of pocket, God forbid, in case something actually goes wrong over there. Coming to the removal situations, there's normally removal for cause and without cause. For cause ends up being if the company does something, some really great goodwill within the entire company and they destroy value, you can actually remove them for these sort of actions that are there. Removal sans cause is in case the company is not performing, doing something wrong, etc. There are certain mechanisms to remove them as well. The rationales are also fairly this one, and the treatment is also fairly simple between the two. In case of removal for cause, your vested and unvested shares are actually liable. And in case you're removed without cause, the shares that you vest legally belong to you, the unvested shares go back to either the ESOPs, management, or they end up actually getting distributed to the new shareholders who end up coming over there as well. The shareholder agreement is more or less just an entire elaboration of everything that's there. 2 minutes, I'll be done. Don't worry. So documents, so the shareholders agreement is normally 300 to 400 pages, which makes you believe that a 10,000 word document is actually called a brief. This is normally where the lawyers come in and end up actually doing a large amount of value add, end up actually scaling out over there. But I do believe that CAs can play a very important role advising their clients how to discern and divine these particular documents and help them interpret the clauses that are actually there. All these documents are based on the term sheet, they elaborate the mechanics of it, and they go into edge cases and details of these entire matters. And it's more procedural in nature, scenario-based, and it actually has everything that you need for a standard agreement, such as the other clauses that the Indian Contract Act actually requires. In terms of reading them, it's not knowing that's half the battle, but look at the definitions that are used. The common parlance of how we use certain terms may not be how these terms are actually defined in that particular document itself. Similar, reading the Income Tax Act or company law, look at the definitions first and then read the documents. Spend a large amount of time on definitions to help you understand how these documents are crafted and who has what rights within. It sort of helps you break through the Byzantine nature of these entire documents itself. So search for certain terms. If you're an investor, search for how you're defined as an investor and what rights you have. If you're on behalf of the founder, what the rights and obligations of the founder, etc., and how to end up doing. Then these are just some rights to check for in terms of the founders. If you are advising a company, look at the indemnity reps and warranties. What are you liable for? How much you're liable for? Under what situations, etc. How you can be removed from your company? How can you maintain control and the rights itself on that? So I think the last part is don't be afraid to ask. I think some of these are fairly, because these are contractual terms and contractual documents for that matter. Many of these may end up being alien to a layperson. Make sure to ask either the lawyer, ask the other counterparty what these terms mean, and let them actually start giving it to you. The other thing is the lawyer only guides you in this entire matter. Don't let them lead you. The CA plays a far stronger role in terms of valuation, price discovery, managing the entire thing. And I'm hopeful that one day the CAs will play a stronger role when it comes to interpreting and managing these documents also with that. So with that, I'll actually just draw a conclusion to the entire talk this. I think we just managed to be it within time. I think we have 5 minutes, ma'am, for question and answers if there's anything. Otherwise, I'll share this presentation with everyone. There's a lot more detail within this, which you can also look at your leisure, sir. So thank you, everyone. So normally what happens is the failure rate is more concentrated in the earlier stage. So the promoter normally ends up just losing the face value of securities that they put in, as well as time. But the one thing that's also very important is that if an entrepreneur fails, the chances of them starting a new company and raising more capital actually increases. So failures actually become one of the things investors look at, because failure equals X mistakes, and the chance of success actually end up increasing. So failure for very large companies, let's say for example, if a large unicorn or someone goes down, normally yes, there's large scale value destruction, but what founders also do, which is very smart, the company fails, normally the promoter is the last person to get money out during the, so the bank will take its first piece, the investors will take their first piece, etc. Because a large amount of this is based on the capital that goes in. So normally, unlike your traditional businesses, the professionals managing these companies normally only put in face value. So they start off a company with 1 lakh, 5 lakh, etc. That's a maximum capital they'll actually put in. Then they dedicate time, resources, energy, etc. to it. And even as the company grows, because they own 100% initially and get diluted over time, they end up taking money off the table. So they do, the smartest investors, the smartest founders you've seen, normally end up liquidating their securities over time, and as the company becomes larger and the shareholding goes down, they ask for an ESOP or MSOPs, management stock option plan, so they end up increasing their shareholding. So even though it may seem like the promoter may end up being disadvantaged, the promoters are also very smart to end up actually creating ways for them to get liquidity without actually suffering all negative consequences, God forbid, if something goes wrong. So happy to speak to you more on some of these mechanics, maybe a little later as well, on that. Perfect, Good. So thank you very much, everyone. If you have any questions, you can just reach out. Thank you. Sid?
For 2 minutes. It was a perfect session to kickstart this startup marathon of 2 days. Thank you, Siddharth, for taking your time out. And then it was not just an insight into funding, but it was an insight into the startup world and how it functions and what are the, though it was smaller, certain tips were very useful. Thank you so much. May I request CA Geeta AB to hand over a token of memento to Siddharth. Can we have a big round of applause to Siddharth, please? Thank you, Siddharth. I will request my colleague CP Jain to take over this session. Thank you.